Let's get right to the floor show. Joining me now, J.P. Morgan Private Bank U.S. equity strategist, Abby Yoder. Abby, cut to it. Do you see any real fundamental cracks in the AI story?
No, I mean, actually, we were obviously talking about this right before, but everything has added up to be very solid. I think you make very good points, though, when you're thinking about like what's happening with different companies, right? And this is idiosyncratic with what they're doing with their debt profiles, right? For the most part, the hyperscalers are net cash, right? Like they can take on, they can lever up a little bit. They're, 0% net debt to EBITDA. Let's say they go to 2 to 3 times net debt to EBITDA, which is like a normal investment grade company. That could add like $600 billion in firepower for these companies, right? Not saying that they're doing that, but they could do that, and they have the cash and the balance sheets to be able to do that. But if you combine, heavier debt loads with return on investments that are 5 years out and tied to one customer, you get a little bit of a question.
And at some point, don't you think the ratings agencies are going to be sniffing around? At least they should be. That's their job. And asking the same question and putting some of that debt on notice.
Yes, exactly. And I think to your point, in the CDS market, that's becoming a very popular way to talk about how to hedge like downside risk to the AI trade on the equity side.
Looking at earnings, are earnings too dependent on the AI trade? We've had just a gangbusters earnings season here. I think 80% of the companies in the S&P that have reported have beaten on profits. That's a very nice move.
No, and I actually think what we saw this quarter was encouraging in the sense that you saw more of the 493 start to finally participate, right? Like the story over the past 2 years has been that the Mag 7 is driving 50% of our earnings growth. What we saw this quarter, coming into the quarter, expectations were for 3Q earnings to grow 7% year over year. They're now going to grow 13 to 14%. They've almost doubled. And yes, a lot of that was driven by the Mag 7, but this is the first quarter in about 2 years that we're actually seeing the 493 see an acceleration above that mid-single digit growth, right? So really starting to contribute. A lot of that was driven by financials, but it was really just, we only had 2 sectors that had negative year-over-year growth rates this quarter.
So why the hysteria here? I mean, everything was up. We are talking some big, big gains. At one point, the Dow was up as much as 717 points. And as I mentioned, the NASDAQ had been up 583 points. Huge gain for the S&P, 128. And here comes the VIX. I mean, earlier today, the VIX went as high as about, I'm seeing, nearly 28. So it went to 28, up about 15%. It's slightly off that now, but still gaining about 8%, I think, and 6.6%. So we're at 25 and change. What's going on in the psychology here? I
mean, I think we've been a little bit spoiled since the volatility in April and May, right? Like it's basically been like straight up into the right. We really haven't. We went over like 115 days without a 2% pullback. That's not really that normal, right? And it was a confluence of different things, right? It was this decline in policy uncertainty. It was earnings coming in better than expected. It was the AI trade really starting to work again after post DeepSeek, skepticism. And so it all lined up, but I think we got a little bit spoiled.
Earlier, you guys were at 3 different sectors that you liked. You've upped that to 5 now. You've added 2 more. Healthcare is one of them, but of course you have really liked things like tech. What is your favorite area here?
Well, I think they all play different roles in the portfolio, right? Like I think about, so we're overweight tech, industrials, utilities, healthcare, and financials. And I think about tech, industrials, and utilities as somewhat all kind of encompassed in this AI trade, right? They're kind of going to move together, right? Tech is building the technology, utilities are powering that technology, and industrials are building that technology. And then there's financials and healthcare, which I think are more of a ballast in a portfolio that will act a little bit differently. Healthcare in particular will zig when tech is zagging. Like if you look over the past couple of weeks where we've seen this pullback in the tech-related and AI-related names, healthcare has really outperformed, right? So if you think about it as a defensive ballast, and it's underperformed for 3 years.
3 years.
So really think, and we're just seeing green shoots in terms of earnings, in terms of policy uncertainty coming down, and we're starting to see M&A pick up, which is a really net positive.
Really quick, right now, S&P's at 65.77. What is your blue sky scenario here?
Yeah, so we just released our 2026 outlook. Our base cases that we are at 7,300 for the S&P, so that's a nice double-digit return. We have a bull case that's north of 8,000, and that's really, where you see this proliferation of AI.
What's the bear case?
The bear case is down 30%, but we don't really talk about that one that much.
Okay, well, at least we're on the record as mentioning it. You never know with this stuff. Abby, great to see you.
Thank you so much.
Abby Yoder.